Did you know the Fed doesn't actually control mortgage interest rates? They only heavily influence them. Here's how that works. Right now, inflation is high, and the Fed is trying to ensure a healthy economy by increasing interest rates to try and cool off the economy. Here's my buddy Jerome Powell.
That's going to require the Fed to tighten interest rate policy and do our part in getting inflation back down to our 2% goal.
The way the central bank does this is by changing what's called the federal funds rate. This is the Fed's main tool for managing the economy. You can see by this chart that the Fed rose the interest rate to almost zero in 2020 to try and boost the economy. Adjustments to the federal funds rate influence a range of borrowing costs across the economy, including the mortgage interest rates. On top of that, they also shape broader decisions made by large companies, like how many people to hire or whether to raise prices or not. Here's the important part. Here's how the federal funds rate works and how it influences the entire economy, including mortgage interest rates. The federal funds rate is the amount that banks charge each other to borrow money overnight. But there's a catch. The federal funds rate isn't actually set by the Federal Reserve. Instead, they try and influence it. So in order to influence it, the Fed uses a couple other tools to set a target range that they're comfortable with. These tools are rates that the Fed directly controls as its role as the central bank. Here's the target range that the Fed had in place during 2021. So the Fed has an upper limit and a lower limit with a goal of trying to keep the effective funds rate somewhere in the middle. On this graph, you can see the target range that the Fed has set between the two yellow lines. The blue line, which is the effective funds rate set by banks, sits between the upper and lower limits of the federal funds target range. As you can see, as the target rate shifts, the effective funds rate shifts with it.
So far, they've had very successful control over guiding the federal funds rate and guiding all short-term money market rates to where they generally are trying to move them.
The Fed generally makes these adjustments in fairly small increments. So the question is, how could these tiny adjustments for banks help cool down the entire economy? If you've ever thrown a stone into a pond, it all has to do with how those rates ripple through the system. As banks are charged more to borrow, they then in turn charge their customers more to borrow. That affects the cost of existing loans and the demand for new borrowing. The goal right now of raising the interest rates is to drive down demand. Now, in terms of housing, they have succeeded in reducing some demand. Let's just say the national average of homes in the United States is $400,000. At the beginning of the year, because interest rates were lower, 36% more people could qualify for that same $400,000 property. Now, those people that could have qualified to buy a house are now renting, which is why rents have gone up over 15.3% just this year. Before the pandemic, the average for rents going up was only at about 2 to 3% a year. Now that's caused massive inflation in rental prices. In addition to that, as long as interest rates stay up, it's going to be more expensive for home builders to build new homes, which is still going to cause a supply-demand issue.
Inflation results when supply and demand are out of whack. The Fed can't do anything to increase the supply of oil or to increase the number of houses for sale. The supply side is something out of their reach, but they can bring supply into balance by reducing demand.
Now this has been a double-edged sword for both consumers and the Fed. If you have questions about how all this might affect you and your plans, give me a call and comment below and let me know if you found this helpful.